Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, June 12, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. So all in all today, we didn't have much movement in the markets. We did grind a little bit higher in most of the markets. However, we really didn't get very far. One of the reasons for that is, and remember we discussed this last night and we also discussed it last week, that the FOMC is meeting today and tomorrow. It will culminate with likely an interest rate increase tomorrow. Now, the market expects the Fed to increase interest rates by about 25 basis points or 0.25%. So as long as there's something on par with that result, the market should really not have a big reaction in one way or the other. We did have the conclusion of the summit between the U.S. and North Korea in Singapore. That seemed to go well, obviously depending on who you talk to. Listening to the conservative commentary, everything is great. Listening to the opposition commentary, if he walked on water, meaning President Trump, then they would say he's not able to swim, which is why he walked on water. So either way, depending on who you talk to, you get a different take based on the summit between the U.S. and North Korea. Either way, no impact on the market, and that's really all we care about. The last thing we're going to do here on this channel is get political. So let's discuss where we are on the charts, where we're going, what the likely scenario is going forward. We're going to use visuals and common sense to determine what we do from here. Before we get into that, let me make mention that I appreciate everybody's comments and postings underneath the videos. Please continue to do that. I love to hear different perspectives on the market, the economy, whatever you want to talk about, as long as it's somewhat related. I thank everybody for their participation. In addition, please continue to like and share the videos with those that you think can benefit from this information. It's helpful to me. It's helpful to them. So please continue to do so. We're all paying it forward a little bit. I believe in karma. So therefore, if you do good, good comes back around to you. So what do we have on the daily SPDR chart? Well, we have another day where we can argue the market put in a doji candle, which is generally a signal of a trend change. So it's kind of like 2 days in a row. I just want to blow up the chart, and we're going to take a look at these candles a little bit closer. So you can see here that you have one from yesterday and one from today. Now, I'm keenly aware that depending on what technical analysis books that you might have read, they have names for these type of candles. I don't like the names. I think they're all nonsense. Let's just look logically where we are. So we rallied up into this area right around 278, 279, 280. And the question is the market going to stall out? Are we going to turn around and go back down the other way? Or are we going higher? That's all we really care about. Which direction is the market going to go? And the reason that's all we care about is because all the stocks related to the market are going to follow suit. Not every stock, but for the majority of stocks, a rising tide will lift all boats. If a market is rising, most of the stocks in the market are rising. If a market is falling, most of the stocks in the market are falling. Well, here's the bottom line, and we talked about it last night. I want to reiterate it today. Based on last week's close, the weekly close in the SPDR was extremely bullish. Doesn't mean we can't have a pullback, but in this case, until proven otherwise, pullbacks are likely going to be meant to be bought, meaning pullbacks are a buying opportunity for now. So as long as we stay above 275.45, that's the purplish line running across the screen. As long as we stay above that on a daily chart closing basis, then there's really technically nothing wrong with this market. Let's look objectively. What do we have? We have a low. We have a higher low. We have a higher low. We have a higher low. So you can see the trend is up. Let's not mess with the trend. If the trend is up, the trend is your friend. We don't want to fight the market. If the market starts going in the other direction, meaning downward, and we hit some important levels on the downside, that will create or produce sell signals, which will bring more selling into the market. But that's not what we have now. Let's not anticipate what might happen. Let's take a look at what is happening and figure out how we can benefit from what is happening. We're above all the moving averages. This market is in a bullish uptrend for the time being. So until and unless proven otherwise, that's the strategy that we have. So what are we going to do with this here? Well, it looks to me like the market may be setting up to go sideways for a few days. If that's the case, then it will be setting up, building pressure to go higher. It will be building energy for another move higher. But it's a little early to tell right now. We have a Federal Reserve announcement happening tomorrow. That can certainly send a spark through the market. But I think everything that they're going to say tomorrow is most likely built in already to where the market is today. If we get a surprise, that's a different story altogether. So from a daily chart perspective, staying above 275.45 is going to be bullish for the market. Now, just to reiterate one more time, let's go back to the weekly chart and we'll take a look. This is the level. We closed above this breakdown candle. The high is 274.40. As long as, and I have my level obviously a little bit higher, 275.45. I think the market would run into trouble below that level. However, the point is that we've broken out above a very important price level in the market. Let's just respect what the market is telling us and just have an awareness of where we are at this point in time. So the spider, even though we're nowhere near today all-time highs, doesn't mean we can't get back to all-time highs, but they're not going to just hand it to you. Truth be told, we're still in an area where there is a lot of resistance up in this zone. So we're going to have to punch through here somehow, some way. Either we have a big gap up and we jump over some of these resistance levels, or we go sideways for a while, eat some time off the clock, let the market build the energy it needs in order to push higher through these resistance levels. Where are these resistance levels? Well, look at this. You can see here, that level is important to the market. This level is important to the market. This is where we broke down. There's a gap fill up in this area here, right above 280. So you can see here, there's a lot of reasons why the market would generally find resistance in this zone. Doesn't mean we can't get through it. We just have to be aware of where we are. Here's an hourly chart of the spider. So I just want to point out a couple of things that I think are important. For the purposes of this conversation, let's assume 278.50 is important. I believe it's important, but for the purposes of this, I need you to believe it's important as well. Yesterday, the market ran down to retest the 278.50. Remember we talked about it last night. All that happened was, in fact, I'll bring back the 10-minute chart. All that happened was the market came back to test a former breakout area. We talk about this each and every night. Here's the consolidation point. I'll highlight it with a circle. So here's the consolidation area. We broke up and we came back down to test that breakout point at the end of the day. Okay, fair enough. Now we go over to today. I want to go back to the hourly chart. So we go over to today. And what happened today? We stayed above that level for the majority of the day with exception. What was the exception? We had a gap that needed to be filled. Where's that gap? 278.20, right here. Here's that gap that got filled. So that officially comes in at 278.20. What was the low of this candle here in the afternoon? The low was 278.19. Does anybody think that that's an accident or a coincidence? Of course not. The market came down, filled the gap, 1 penny, reversed higher, went the other direction, back above the 278.50. This is bullish. There's no two ways about it. How do I see this? I see this as an up move, and I see this as consolidation, building energy for another move higher. That's what I see on the hourly chart. Here we are once again at the IWM chart. The Russell 2000. This is my favorite market leading indicator for obvious reasons. It generally leads the market in either direction, up or down. Right now, this is in a melt-up scenario. We have another closing high. In fact, we're at an all-time high and a closing high in the IWM. This is an indicator, folks. This is a proxy. This is the market's way of telling us that higher prices are coming. It's not an accident and it's not an aberration that the IWM or the Russell 2000 index continues to grind up to new highs. That's the market's way of telling us there are higher prices coming across all the markets. Is there anything wrong with this market? Absolutely not. Are higher prices likely? Absolutely. Until and unless this market shows signs of weakness, until we get some kind of a reversal signal, higher prices are coming. This market is going to continue to grind higher until it tells us otherwise. The NASDAQ market, the QQQ, we're not necessarily at a closing high today, but we're just a few pennies away. Again, this market is in an uptrend. We're well above all the moving averages. While we may be in a slightly overbought condition similar to other markets, this is in an uptrend and has to be respected as such. So what are these markets really telling me? When I look at the IWM and I look at the NASDAQ market, whether I'm looking at the NASDAQ Composite, the triple Qs, the NQ, it doesn't make any difference. When I look at the tech sector and I look at the small caps, these are where money goes for growth. These are markets that attract risk assets. When money is flowing into these markets, that's the market's way of telling you that A, there's no fear, B, unless something wacky happens, higher prices are coming. Sure, the volume is light across the markets, but volume's been light for years. It typically only picks up on the downside. So we can continue to grind higher on light volume indefinitely. You really don't want to fight the mutual funds, the hedge funds, the pension funds, the investment banks. If all those market participants feel the market's going higher and they continue to plow money into the market, then it becomes a self-fulfilling prophecy. They're going to drive prices higher along with the retail investor who's going to jump on board and try and ride the wave. The bottom line is, don't fight the trend. The trend is up right now. Go with it until the trend changes. Right now, the trend is up. If the trend changes, I'll let you know. Now, of course, the market's not going to be up every day, just like the market wouldn't be down every day in a bear market. But the trend is up, and that's the bottom line. Take the long view for a second. Here's the weekly chart of the Qs. Now, when you see stuff like this, you see the market well above all the moving averages. So we may be overextended or short-term overbought based on the fact that we're pretty extended from home base. The 20-period moving average is home base. So do we have to go sideways for a while or come down a little bit to let home base catch up to price? Maybe so, and that's fine. That's where I say we're not going to be up every single day. We're going to have little corrections along the way, but the trend is up. And here's one of the telltale signs. When you see the spacing in between moving averages, so this one is in between the 20 and the 50-period moving average. 20 is red, 50 is blue. When that spacing exists, that's the market's way of telling you it's in a strong uptrend. Now look at the spacing in between the 50 and the 100-period moving average. Same deal. The spacing is even getting wider. What's that telling you? Weakness or strength? It's strength. It's telling you the market is strong. And same thing goes for the 100 to the 200-period moving average. The spacing is actually getting wider. That's telling you the market is strong. It's in an uptrend. Until and unless this trend is broken, it's a bullish tape. Back to the daily. Remember, we talked about this at length. The market was making a bullish consolidation over the 166.88 level. And guess what? We took off to the upside. It's exactly what the market was supposed to do out of a bullish consolidation pattern. The transports. Nothing new here. We continue the breakout since we've consolidated above the top end of that channel that we talk about all the time. Now we're breaking out above that, and this is bullish. Now, of course, we're going to pull back here and there, but this is bullish, and this is a market that you don't want to get in front of. We're above all the moving averages. The 20 moving average is sloping up. We're a little bit extended from home base. Probably have to come back or go sideways for a while, let home base catch up to price. But either way, this is not a market you want to get in front of. This is bullish. Higher prices are coming. The broker-dealers. The financials still happen to be one of the last holdout markets that really haven't picked up steam to the upside. Now, we can make a case that this is building a bullish consolidation to make another move higher, but we just don't want to lose sight of the weekly chart. Until and unless we can close a week above the high of 297.99, this is the broker-dealer index, then this is still technically a bearish pattern. But what's interesting is we're above all the moving averages and really still in an uptrend, so I'm going to go out on a limb and say we're eventually going to get above that weekly level in the XBD. The XLF, same deal. The weekly chart doesn't look great. It looks like this is a bearish pattern that will generally play out to the downside. Here's the daily chart. Remember the 100-day moving average. We'll see if we can build some energy to get through this 100-period moving average. But the financials are one of the last holdouts that really haven't staged any kind of a decent rally just yet. Maybe there'll be some sector rotation. Money will flow into the financials. But you know what I always say? Without the financials, the market is unlikely to stage a substantial rally to the upside. They have to participate if that's going to happen. On the flip side, the market is unlikely to break down with any substantial selling pressure if the financials aren't following suit or at least leading the way. So we'll just keep watching these each and every day for clues, but the remainder of the market is telling us higher prices are coming. I have to believe the financials are going to get pulled up along with it. Now, if we see the financials begin to deteriorate for one reason or another, then it may be a canary in the coal mine and a signal there would be trouble ahead. But we just don't have either way right now. We don't have one or the other. They're just kind of spinning their wheels in the sand. So we need more evidence. We need more clues. We need the financials to stage a rally or potentially a decline that would tell us something else is going on. Now, before we move on, and nobody asks about this anymore, but here's Bitcoin, and here's the reason why I want to talk about Bitcoin. When Bitcoin was at $15,000, $16,000, $17,000, $18,000, $19,000, everybody wanted to know about Bitcoin. They wanted to know how high it was going to go. They wanted to buy Bitcoin. Everybody couldn't get enough of Bitcoin. But we've seen this over and over and over again. If you've been in the markets for any long or lengthy period of time, you've seen multiple booms and busts, bubbles and bursting of bubbles. We've seen over the last 20 years, we've seen the dot-com bubble, the tech wreck. We've seen the real estate bubble. And the latest one is the Bitcoin bubble. Look what happens if I bring over a weekly chart. You can see here that the high on Bitcoin was 19,707. When it was over 19, you started hearing ridiculous numbers like $50,000 Bitcoin, $100,000 Bitcoin. It may happen at some point in the future, but that's the way bubbles happen. As something's going higher, everybody seems to think that because it went higher yesterday and last week and the week before, they think that the short-term trend is going to continue. But the reality is, it never does. Those of you that have been around for a long period of time will remember the term irrational exuberance. That came from Alan Greenspan, a former Federal Reserve chairman. I think that came somewhere around the dot-com bubble, if I'm not mistaken. Either way, whether he was talking about the tech sector, he was talking about dot-coms, or potentially even real estate shortly thereafter. I can't remember off the top of my head. But the bottom line is that they're always all the same, whether it's the tech sector, whether it's the real estate bubble, or whether it's the cryptocurrency/Bitcoin bubble, they all do the same thing. They run up way farther than people can think, and then they collapse down lower than people think they can go. Well, here's what we have today. As you can see, I have this line here, so I just want to give you a snapshot of what I'm looking at. So on the daily chart, we actually just broke an important level. This trend line was an important potential support line. However, it's been broken, and when you go over to the weekly chart, I'm going to show you exactly where I think Bitcoin can go. And this is a give or take. It could be slightly less, it could be slightly higher, but I believe that Bitcoin will find some footing right around $5,000. Maybe it gets to 4,600, 4,800. Maybe it stops short at 5,100. But generally speaking, I think Bitcoin is headed for around 5,000. Nobody will want it, and that will likely be an area where we'll find support and see another leg higher. How high? No idea. Can't even begin to discuss that right now. I think it's headed to around 5,000. The telltale sign is I used to get asked to go over the Bitcoin chart almost every single day, multiple times a day. Now, I haven't been asked about the Bitcoin chart in a long time. It's been weeks, if not even longer. It's out of favor. Nobody cares anymore. Once the price isn't rising each and every day and it's not in the news each and every day, nobody cares. They've turned their attention elsewhere. That's the way markets work. As we do each and every night, we'll take a look over at the gold complex or the gold chart. And again, there's nothing to do. There's a pattern inside of a pattern. It's a conflicting story as far as I can tell. I can make a case for higher prices up to, let's say, 13.15 to even 13.20. I can also make a case for much lower prices. When that happens, I choose to do nothing. Let's just let the gold chart play itself out, and eventually it'll clear up to the point where we see a trade ahead of us. Right now, I don't see anything, so we're just going to leave it alone. Crude oil didn't do much today, tried to spike up earlier in the day, but pretty much is ending the day where it started the day. I still think there are higher prices coming. I think we're going to find some resistance at around 77 or so, 67 or so. But if we can get over 67 on a daily chart closing basis, then the next target would be the convergence, or what will be at the time, the convergence of the moving averages. And look what you're going to have at that time. Here's the convergence of the moving averages and some important pivot highs. So you can see how this would be a natural area of resistance for the crude market. But that's short-term stuff. I still think that we're poised on a longer-term basis to see this market rally up into the hot zone, but we have to get off the mat here. And as long as 64.50 holds, and more importantly 63 and change, as long as those areas hold, and they have so far, then higher prices are likely. If something else happens and we begin to break down, and we certainly if we start closing below $63 and specifically below 62, all bets are off, and that changes everything for crude oil. But right now, I still think the uptrend is intact and higher prices are coming. So nothing's really changed from that standpoint. Now I'm going to leave you with this tonight. I'm going to go back up to the chart of the daily SPY chart for a second. And I just want to make mention, and this is only for the folks that actually stayed to the end of the video, what I think is going to happen, and I don't know this for a fact, and this is me going out on a limb a little bit, and we'll get more clarity over time, over the coming days and weeks, but I think we could be on the verge of a market melt-up. That would mean a challenge or higher of the old highs in the S&P 500, and that would also mean substantially higher prices for the NASDAQ market, meaning the Qs, and also the IWM, the Russell 2000 Index. Those are your leaders right now, so on a percentage basis, if I'm right, and we do have a melt-up, then we're going to see exponentially higher prices in those markets than we will in the Dow and the S&P. So if you want to pick a horse during a melt-up phase, if one should occur, then I would pick the Qs or the IWM or both. We'll see. Going out on a little bit of a limb, but I have read this book before. There's certain things that I'm seeing in the market that lead me to believe we could be on the verge or the precipice of one of those melt-up scenarios. And I'll let you think about that, and we'll wrap it here tonight. It's everything that I really wanted to and intended to discuss tonight, so I'll leave you with the thought of a melt-up. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.